Would you like an opinion on a financial matter you're dealing with? Whether it's about retirement, investments, taxes, or 401ks, Scott Hansen and Pat McLean would like to help you by answering your call. To join Allworth's Money Matters, call now at 833-99-WORTH. That's 833-99-WORTH.
Welcome to Allworth's Money Matters. Scott Hansen.
Pat McLean.
Glad you're joining us today. Both myself and my co-host, we're both financial advisors, certified financial planner, chartered financial consultant. We spend our weekdays helping people like yourself. We broadcast on the weekends, being your financial advisors on the air. Whether you've got advisors you work with now or you do things on your own, whatever the case, we want you to consider us to be another source of information for you, and hopefully awesome information.
Well, let's hope. But let them be the judge.
Whether it's awesome or not?
Yes, absolutely.
Yeah. And to join our program, if you'd like to be part of the show, meaning you've got a question for us that you'd like us to see if we cannot answer for you, we'd love to take your call. The contact number is 833-99-WORTH, 833-999-6784.
So if you have a question about IRAs, 401k, mortgages, life
Stock
insurance,
market, real estate, anything financial related for that matter.
Yes. We love to take those calls, and we interact with clients on a, daily basis, most certainly on a weekly basis.
So I saw an interesting article that I read the other day. The title was, this is from the Wall Street Journal, Buy, Borrow, Die, How Rich Americans Live Off Their Paper Wealth. Okay?
Yes.
And so these people that tend to be company founders, a lot of money tied up in one stock.
Really rich. Like super rich.
Like Jeff Bezos rich.
Yes.
I doubt he sells much Amazon stock.
Probably not.
So let's assume you got $100 billion worth of Amazon stock.
And you need to get yourself a hold of a quick $2 billion.
$2 billion. How much can you spend on your living expenses? Not that much, right?
Yes.
Not $1 billion, for crying out loud.
Okay.
A few million a year, maybe? I don't know.
Well, certainly.
Okay, whatever.
Yeah.
Of course you could. Whatever. I guess you can. I don't think you could blow through $100 million if you tried. That might be even impossible.
Oh, I'd like to try.
Oh, he is going to space.
Yeah.
So
that's not,
it's
not
went
free.
to space. So, what the point of this is that when you take a loan of an asset, you're not taxed on that loan. You pull a home equity loan out of your house. You bought your house for $200. It's worth $800 today. You take an extra $100,000 home equity. That's not taxable to you. You have your stock in Amazon. You take a loan against that. That loan, that's not taxable to you. And then under current laws, when you pass away, whatever gain had been there is stepped up. Now, this article didn't talk about estate taxes that are going to take half of this, but
so what essentially that means is I've got $10 million in stock. I need $1 million right now. I actually pledge my $10 million in stock as collateral. I borrow $1 million. By the way, depending upon the type of stock or what you're pledging, you could normally borrow up to 40 to 50% of the value of that. I live on that. The day I die, that stock receives what's called a step-up in basis. And a step-up in basis means that they pretend that there's no stock, that there's no capital gains due on the growth of that stock. So I was able to live off the stock. The cost of living off that stock was the cost of money, the loan on the stock, the interest rate. But in return, I held it till I died, and then
capital gains
taxes
forgiven.
On that.
That's assuming everything goes well. Every year you read about stories of some founder that pledged all securities, the stock price went down, and they found themselves broke because they were leveraged. And to your point, it's for if your net worth's under 20 million, you probably shouldn't be.
Yes.
Taking this
Scott, you and I were at the Newark airport 3-4 weeks ago, and our flight was delayed for 4 or 5 hours, and I was sitting there talking to the one guy who was on his way to Florida.
It's securitized lending.
For a large brokerage firm. And what his job was...
Get you to borrow money from your stocks so you could either buy more stocks or go splurge some expensive.
But not sell the stocks you had.
That's what his job was.
That's what his job was.
Convince other brokers to offer it up to their clients.
That's what his job was.
Because the bank made money off that.
And then...
By the way, if your advisor's with one of those big firms, Those are the conflicts that are going through his or her ears every day.
So we have this conversation because I'm at the Newark airport for 5 hours, and I'm like, yeah, I'll have this conversation. And he's like, let me tell you all the reasons you should have your clients do this. And I said, let me tell you all the reasons I don't think it's a great idea for many, many people. And he said, what could go wrong? And I'm like, okay.
What could go wrong?
What could go wrong?
How about a 50% decline in stock prices like we saw 14 years ago?
How about a change in legislation that no longer gives you a step up in basis and accounts over X amount of dollars or a net worth of X amount? But it's dangerous.
But I think we'll see more. Look, if capital gain tax rates go from 20% to 39.6%, the tax rate will be at some point when we will be advocating even to our middle class client, let's say,
that there are risk mitigation. There are capital gains.
If the capital gains is so great, maybe you don't sell and you take a small loan on it.
Yeah.
That's what you'll see more happen. But look, it cuts both ways. And I heard an ad from this guy I respect too, was pitching home equity loans. He's a radio personality guy, but they read ads for, and he's pitching untapping that equity in your house is doing nothing for it. Get it to work for you. And I'm thinking, all you're doing is betting your house. You're borrowing money, and as collateral, you're pledging your house. How is that? Isn't your money working for you to begin with?
Yes.
It drives me crazy.
I know. You bring it up like every 4 weeks.
I do?
Yes, I know it drives you crazy.
Because I can't stand, I see people come in, they want to be able to, they want financial independence. They've lived in their house for 28 years, the same house. They owe 3 times in their house, 3 times as much as what they paid for their house.
Not unusual.
And they have no financial security because of that.
Yes.
That's what I see.
They spent their house.
What in the world? I mean, it's not like typically the money goes to buy things like fancy cars. And I mean, Honda Accord's pretty dang fancy on a like as far as cars go. If you can afford it, great. But when you're taking money out of your house to go buy new cars,
yes, probably not the best idea.
Anyway, I won't bring it up.
Well, you can bring it up. You can bring it up as often as you want. I agree with you.
I just don't.
But let's go to the calls. 833-99-WORTH if you'd like to join the show. 833-999-6784. See how we got that? 99 worth. Pretty smart.
Let's talk with Lori. Lori, you're with Allworth Money Matters.
Hi, Scott and Pat. Thank you for taking my call.
Sure.
Yeah.
I have a question about ESTs, the Delaware Statutory Trust.
Okay.
We're selling a rental and wanted to do a 1031 exchange, and we were offered this as an option. I wanted to know what your opinion is about it.
So essentially, this is a, Pat, I don't know if you've heard much about this. It's essentially the old tenant in common set up under a different name.
Okay.
And it doesn't have to be in Delaware, by the way, to have a Delaware statutory trust. Here's what ends up happening with this. You transfer your property along with a bunch of other people that you don't know, and you become partners with all these other people. Okay?
Right.
So decisions are going to be made by the partnership that you have no control over. It may or may not be in your best interest. And the second thing I'd want to know is, what are the fees for the syndication of this? How much are the managers making off this whole thing? There was a large analysis done years ago for the tenant in common. This is right when last time the real estate market was hot. I remember I had a client of mine come in. He didn't take my advice on it. He did not take my advice. He asked about these. I showed him I did some research and showed him a report that stated that the average syndication fees were north of 15%.
At that point in time, you're better off just paying capital gains. That was my point.
I said, you're going to exchange this into a property with people that you don't even know, the partner. You're going to be partners with people you don't know. You have no control over. Zero control when the property's sold. No control over.
You can have capital calls on it. Why would you do this? Why wouldn't you just, Lori, why wouldn't you just do a regular 1031 into a property you identify?
Oh, well, I mean, that is an option. But I just thought if we couldn't identify the property in time, or if we bought a property, I guess we would either have to buy two properties to make up for the difference, or put some funds away into this DST.
But why would you? But I would not use the DST. Just flat out.
I see. Because of the lack of control?
Yeah. Oh, 100%. So what's the value of the 100%? Lack of liquidity, lack of control, lack of look. What's going to stop this firm from actually buying their own properties from themselves?
I had another client. She did a similar thing. It was a nursing home.
I remember this.
It was in a nursing home, and she had a few other partners in this nursing home. What could go wrong? Nursing home. It's the people that think. Well, they ended up with vacancies. For several months, she ended up with capital calls. So she had this investment that thought was going to give her passive income. Instead, she was writing checks in on a frequent basis. She's talking to me like, Scott, what do I do about this? I'm like, what can you do?
Yeah, well, you could not do that. You could actually get damped down on your percentage of ownership at a high cost associated with it. Yeah. So, what's the value of the property you're selling?
About $550,000.
550,000 or 5.5 million?
550,000.
And what did you pay for this?
180 plus 190.
What year did you buy that?
2010.
And how much have you put into it above the purchase price in terms of capital improvements?
Were you the first owner?
No.
What was this home?
No,
how old is the house?
We bought it as a rental during the crisis, on the end of the crisis,
So you bought it when things were really cheap?
Yeah.
What year did she say she bought it?
2010.
Okay.
Did that house trade in the 5 years prior to that?
Yeah, at one point in time, Scott's going at this. At one point in time, it probably traded for $350 or $400, and you bought it at $190. Is that a fair statement?
Yeah. Yes.
Okay. So here's where I'm going with this. You bought this probably the perfect timing. Probably the bottom of the market. Yeah. Half what it was trading for a few years prior. You bought because prices were low, and for whatever reason you want to sell it now. The thing is, we are at the complete opposite end of the market cycle. I don't know where the market cycle is going to end, but I know real estate doesn't go up every year by 20%.
Correct. And we're trying to take advantage of it by selling.
but you're not really,
because you're just going to be exchanging it in something else that's gone up in value,
which has gone up in value. It's a 20%. Lateral move. So,
well, we're buying out of state.
Okay,
then go buy
into a lesser, less expensive market.
Go do it yourself. Don't use a Delaware.
No way.
This Delaware Trust, by the way, that's just a new name for the tenants in common. I looked it up while you were talking, Scott. That's statutory. It's just a new name for tenant in common. So you either recognize the gain or go and
it's not just like a typical limited partnership where there's other controls. It's very restrictive
as to the general partner gets.
Yes. Okay.
All the control.
Yeah.
So if
I that was the thing I was not very happy with, the lack of control, and the potential.
How old are you, Lori?
Print,
how old are you?
55.
And is your house paid off?
It was, but we recently took out some equity. I know you were just talking about that.
What'd you do with it?
We're investing it.
In what?
Some real estate, some stocks.
How much did you take out?
You're 55. You took money out of your house to go buy stocks and real estate?
Uh-huh.
How much did you take out?
About $300,000.
Oh my!
So
God.
here's what. And how much other assets do you have? How much money do you have in 401ks or other real estate? You have this rental property. You had your own home. How much other assets do you have?
We have another rental, which is paid for.
Okay.
It's worth about $500,000.
Okay.
I have about 1.5 in 401ks and
good for you.
other savings. Yeah.
Okay. So right now,
That's
you're 55 years of age.
What percentage of your 401k is in bonds?
Oh, very little.
Okay.
I would say about 12% or
Okay.
less.
So here's my opinion. My opinion would be, if you're buying out of state, then go ahead and identify the property out of state and do the your own tax-free exchange, or recognize the capital gain on this and call it a day. Take any of the proceeds from this and put it back down on your home mortgage to pay that down. You're 55 years of age. You might want to retire in the next 10, 15 years.
Right.
Right?
Or at least
Or
have the
Or
ability
sooner.
to.
Then you should actually start planning with that. And part of that planning means risk mitigation.
Okay.
So that's
Because what happens if we go through another period like the financial crisis?
we will.
Yeah, we just don't know when.
Right.
Yeah, I don't know when.
Yeah.
And actually, if I did know when, I wouldn't tell anyone.
Nor would you be doing this radio program.
That's right. So here's what we see here is that you're doing a risk. You don't have any guidelines around risk that are actually guiding your behavior. Because
Probably true.
you paid down
and
your
if you
mortgage
just look at-
significantly, did you not, over the years? And then you just borrowed it back out in a whole lump sum.
At a time when prices are astronomically high on a historical basis on almost every asset class. You bought this rental at
I know,
the perfect time.
I know we didn't, but you didn't call us up for us to beat.
right.
You need to step back for a couple minutes and actually look at your own risk. And you might want to pay someone for some financial advice to actually do a financial plan that says, I'm going to
Probabilities of
retire
outcome.
in 7, 8, 10 years. What are my probabilities of getting there? And they will actually build models that will actually show you how to get there. So I appreciate the call.
Yeah, wish you well. And so obviously we answered a question on the
Thank you.
what if that was
Yeah.
on
And we didn't mean to.
No.
But it just
You
shows
know-
we care a little bit.
I can't tell you how many people we saw, whether it was the financial crisis or the .com. Now, I was a little nervous about the debt. She's got quite a bit in her 401k and another.
Makes
So
it
she's
better.
I felt much, much better. Because sometimes you see people that just end up with too much debt. Markets turn south. They get into trouble. I don't think that's going to happen with Laura because it was a very small percentage of her portfolio. But sometimes paying the capital, look, you invest to have a gain. Sometimes paying a capital gain is not that. For a lot of people, the net proceeds are going to be more today than they would a year ago.
You and I sold a house that we owned together last year. Did we pay capital gains on it?
We did.
We did.
And we sold some raw land earlier this year.
And we paid capital gains on it.
Yeah.
Scott and
I've
I
also exchanged properties.
So every situation is a little bit different.
Yeah. Every situation is different. But look, and I'm not predicting the real estate market's going to take a dump, nor the stock market's going to take a dump. Actually, I am. At some point in time, we will see declines in values of both. We'll see declines in residential real estate again. We have in the past. We'll see it again. We'll see declines in stock prices. I don't know when. Maybe it won't be for 5 years.
Wow, it's as soon as the quantitative easing frees up and we start to see a rise in interest rates, we will most certainly see an effect on both the bond and stock market and real estate market. So the question is,
That's why they're not-
how quick are they going to do it, and how
That's why
fast are
they
they going to
haven't,
do it?
isn't
That's
it?
why they haven't. But you can't live in this fairy fantasy
And if you
pixie
jack
dust
up
world.
if you jack up interest rates, then suddenly the servicing the debt takes a whack out of your budget. How are you going to pay
But
for
you
all
can't
these-
live in this world forever. I mean, you can't live in the world where we're going to protect every risk asset from economic downturns because the Federal Reserve is going to step in and back it all up. Just it can't live there forever. You're going to have to let the free markets control themselves at some point in time to at least some degree.
Because there's no better way to clear to allocate capital than the free markets.
That's
my opinion.
None that we have so far.
Yeah. All right, let's continue on here. We're talking with Jenny. Jenny, you're with Allworth Money Matters.
Hi there. Thanks for taking my call.
Yeah.
So I've been a widow for about 4 years, and I have 3 homes. My personal home I own, paid off. I have one rental I owe about 105,000 on, and then I have a second rental. And my question is about that second rental. It is paid off. My husband and I purchased it in about 1985 for $60,000. My concern is about what you're just talking about. I don't know whether I should sell it right now and eat the capital gains or take a chance and keep it in the portfolio because it does generate income. Right now, it rents for about $1,600 a month, and the annual cost on insurance and taxes is about $500 or $5,000. Wish it was $500.
Okay, so you're netting about $13K.
Yeah.
And what's it worth?
Money coming there. But I'm concerned about the drop in the market and the increase in capital gains taxes right now.
What's it worth?
It's worth about $400,000.
And your husband passed away 4 years ago?
Yeah, and my attorney did have me have all three houses reappraised at that time. So I don't know if he did anything with the county to step it up, but he did take his name off of all of the paperwork. So it's all in my name now.
Yeah, there's nothing in the county to step it up. This is an income tax. So whatever the value was worth when he passed away, assuming this is held in community property, that's what the value you look back towards, not what you paid for it back in 1985.
Other than this $105,000 on rental number one, do you owe anyone else money in the whole world?
No. I own my 11-year-old car. I own a motorcycle. I don't,
What are you living
I don't know
on?
anybody. I actually am working full-time still. So I actually am receiving survivor benefits from my husband's Social Security, and that's about $2,200 net a month right now. I make about $130,000 a year, so I was going to quit and travel, but then COVID hit.
And you're age 60. Well, I know you're between age.
I'm sorry, I'm 67.
Okay, I was going to say I know you're between age 66 and 70, but
what's driving you to consider selling rental number two? You made no mention of rental.
The potential for the capital gains taxes to go up and taxes in general going up.
And how much money do you have in Iras?
So in Iras, 401k and annuities, about a little over $1 million. I have $200,000 in savings. I've been afraid to pay off the other house just because I didn't know what was going to happen this last year with COVID hitting and wasn't sure about the economy in general. My portfolio is pretty much half and half stocks and bonds.
Okay.
Unless there's something really bugging you about this rental, I don't know if I'd sell it.
And do you have? Will you be receiving a pension when you retire?
No, just Social Security, and I was just going to step it up to mine when I was 70 and a half.
So the only thing I would do, and I'm going to agree with Scott.
I mean, if there's some reason you don't want to have it anymore, that would be a good. I don't know when the market's going to. I don't think rents are going to fall anytime soon. And rents is really the nice thing about this increase that we've seen in real estate prices. It's been driven in a good portion, at least, by rising rents. I'm not. Right. Maybe that's not good for the people that are renters. I'm not. But at least that there's some real. There's a mathematical formula that one could put on the rising real estate prices. When we had it the previous time back in the 2000s. Rents were totally flat, and real estate prices were going through the roof.
And we've got some demand issues going on right now.
Yeah, I live in Denver, so I understand that totally.
So here's what I would do. Unless there was a reason that was compelling me, like, I hate these tenants, I hate everything about it, I need to get out of here, I would just leave the rental alone. I most certainly would take some of that money out of the bank and pay off that. You said you had a couple $100,000 in the bank?
Yeah, a little over $200,000 in the bank.
Yeah, just take that and pay off the rental number one. Okay. And if you're worried about your equity allocation, you can, underweight equities more, but I think you're fine at 50-50.
And part of the reason I was saying hold on to this rental is my question would be, what would you do with the
money otherwise?
Because you got $200,000 sitting in the bank because you're afraid to, right? So then what do you do with it? You're going to go buy bonds? That didn't make a lot of sense. You're going to go buy stocks? Well, I don't think you'd want to be doing that either.
it's kind of unfortunate. I sat on the 200,000 thinking that the stock market was going to go down, so I didn't want to play around. I was waiting, and it's done nothing but go up.
Well, so far.
I lost my opportunity there, but
Okay.
I felt secure.
You've done awful,
It's
Jenny.
about security.
You've done terrible. What are you complaining about?
I'm not complaining.
You can't look at it that way.
And then you made the decision based upon your risk tolerance with all the available information you had at the
Correct.
time.
You're in good shape.
All you want to do, like to clean up around the edges, is just pay off rental number one, call
That's
it a
what I
day,
do. And you're in great shape.
And you're in great shape. And work as long as you enjoy it. And then the minute you don't, you know what to do. Just go travel.
Yeah. Okay.
All right. Appreciate the call.
I appreciate the call. Thank you.
Yeah, thanks for joining us. We're going to take a quick break. We'll take more calls when we come back. 833-99-WORTH is the number. This is Scott Hansen and Pat McLean of Allworth Financial.
Can't get enough of Allworth's Money Matters? Visit allworthfinancial.com/radio to listen to the Money Matters podcast.
Welcome back to Allworth's Money Matters. Scott Hansen.
Pat McLean.
Glad you're still listening to the program. Anyway, but hey, before we go back to calls here, and we will go back to calls, we've got live workshops coming up August 14th. Actually, today, but you probably missed that one if you're listening to this. August 14th in Sacramento, Denver, and Cincinnati. The Social Security workshops are 5 steps to managing your Social Security, and you can register at allworthfinancial.com. And then secondly, we think our phone calls are what make the show more interesting. We can talk for hours, trust us. But we like taking phone calls because what people have told us is oftentimes they'll get a glimpse of some aspect of their own financial life by listening to someone else present something that's happening in their financial life.
Or they can feel really good about their own financial life based upon.
But the funny thing is, the majority of our callers are still our radio listeners, not our podcast listeners, although we have many more podcast listeners. My point is, if you'd like to join us, if you got a question for us, I'm curious what these guys would think about my situation. Would love to take your call. You can call this number and just set up a time. We schedule our calls in the studio periodically, and we can schedule a time that's convenient for you. Well, as long as it's convenient for us as well. That'd be totally transparent. But and then we can just take your question and work great. So to join us for that, 833-99-WORTH is the number. 833-99-WORTH or 833-999-6784. And we will get you something scheduled.
Get you on the air.
And if you forget that, you can send an email at questions@moneymatters.com, and we'll get you there too. Let's talk with Judy. Judy, you're with Allworth's Money Matters.
Hi, good afternoon. Thank you for being available to answer my question.
Oh, thank you, Judy.
What can we do for you?
Well, I have 3 grown children and 5 grandchildren. And for the 3 children who are now close to 40, I did 529 accounts to save for college, and it worked well for them.
Yep.
I have recently opened some 529 accounts for my grandchildren, but I am aware of a lot of discussion among financial investment people who no longer believe that 529 accounts are a good vehicle to save for grandchildren for college. I'm aware of the fact that in the last 2 years, for example, there have been fairly significant returns through the stock market in investments that are not 529.
Mm-hmm.
But I'm also aware of the fact that I don't pay any taxes on, they don't pay any taxes on whatever the growth is
Okay.
over the life of the investment, except perhaps for state tax, but no federal tax.
And what alternatives have these advisors offered to the 529 plan?
Pretty much just, investing in mutual funds, separate account for them,
Okay.
and you let the market do whatever the market is going to do.
So let's step back for a second and actually understand what a 529 is. A 529 is just a label on an account. It is not an investment itself. So when someone says a 529 plan, it's like an IRA. An IRA is not an investment. It is actually part of the tax code. A 401k is not an investment. It's part of the tax code, right? A 529 is actually tax code. It's not the investment itself. So inside of that 529, you can hold lots of different things. So the way it is structured right now is each state in the United States actually will pick one provider for 529s for that particular state. Why that is, I have no idea. It makes absolutely no sense to me whatsoever why they should actually have this federal tax code and then allow the states to somehow get involved in the administration.
Because it was designed just like the 401k. It wasn't actually, when it was set up, it wasn't intended for this purpose. It came from prepaid tuition plans.
Oh, is that how it
Someone
started?
found a loophole around it.
Okay, so in that 529,
Hold on,
what's that?
guys.
Yeah.
I don't think that's necessarily the case, because you can invest in 529 accounts in something like the Washington Mutual Investment Fund.
That's right.
Or
And I think
funds, and those are national. They're not just
No.
California.
They sit inside the 529 plan. So it doesn't, so you're talking about the American Funds group of things where you can buy Investment Company of America or
can buy the
Washington
same thing
Mutual.
in
You can buy it in
529.
the 529 plans. In fact, I know that for a fact because I did.
Yeah.
Right?
Well, that's what I did.
Okay, it doesn't make it taxable.
I don't understand the argument against the 529 plan. But you started by saying that a lot of people in the financial...
But you could buy the S&P 500 in the 529 plan. So there's a large enough selection in the 529 plans across the United States that you can get as much equity exposure as you want.
So that's what I think is confusing us, Judy, when you brought the argument that the stock market's done well, so you don't know if the 529 plan's good. What is it you don't like about a 529 plan?
And it's not that I don't like it about it. So let me give you an example.
Okay.
And this is a bit of a topic of discussion among a group of people who I know. So,
Okay.
So let's take and anything. If you're going to invest in an American fund, a Washington Mutual Investment Fund, and you compare it to what if you had just invested in a S&P 500 or Dow Jones Market Index Fund or something like that, it hasn't done as well as those funds.
Okay.
I don't know if it has or not, but the point is you can buy an S&P 500 fund in a 529 plan.
You can buy the Qs, right? The NASDAQ in a 529 plan. You can buy lots of different things inside of a 529 plan.
Okay.
So what I'm
you're
saying...
not really,
I'm sorry?
I didn't mean to interrupt you.
No, go ahead.
Some of the plans in some of the states limit you
Absolutely.
to what you can buy.
Absolutely.
But it looks like at least in California, it's not limited.
But you don't in California. You can get a plan from any state in the union. It doesn't have to be in California.
So if you wanted Vanguard's plan, you wouldn't use California. You'd use Utah, and you're allowed to use Utah plan. You don't have to use the plan from the state.
Some states will give you a tax deduction or some tax benefits if you reside in that state.
But you don't have to use the same state that you or the grandchild or child actually reside in. It's got nothing to do with the state. It's just the way the rules were written that each state is allowed one plan administrator.
I do understand all of that. I guess the bottom line on the discussion amongst people is that the generalized rates of return that you get from, quote, investing in 529 accounts for college education don't seem to do as well.
That's emphatically false.
Wrong.
Okay,
Maybe the amount of dollars in 529 plans, depending on where they're invested, but you have almost the identical options within a 529 plan as you do outside a 529 plan. Period.
and you get better.
You're talking to some brokers trying to sell you an American funds plan. That's what your problem is. Frankly, he's a commissioned broker.
Yeah. And
He's trying to sell you his product. Don't confuse the two. And not to get frightened. I mean, it's just the reality is, I think as a grandma, I think it's great you're saving for your kids' education.
There's no better place to do it than a grandparent.
Correct.
Because it stays in your name and not in the child's or the parent's name.
And it's out of your estate, so it's not subject to estate taxes. And you can preload many years of in the plan without being subject to a gift tax.
So we don't have to make it difficult. Just go and buy the S&P 500 in the 529 plan for whatever state you want to do it in your grandchildren's name. And forget about, you brought up American Funds and Washington Mutual and all that stuff. Don't worry about any of that garbage. Don't tell you with the brokers. He or she could make that argument, them or they, all day long about underperforming. And I will tell you, it might be a little bit more expensive, maybe 1 or 2 basis points.
I can't imagine why someone would try talking a grandmother out of a 529 plan for the grandkids. I honestly cannot understand. I cannot think of a situation where that would not be a good. I can't think of one.
Judy, were they trying to talk you out of it?
This is not a discussion with like the broker.
Okay.
This is a discussion among co-equals, so to speak.
Oh, we'll have them. Listen.
Don't get your.
Look.
I could talk to. If I talk to my friends about how to overhaul my car engine. Yeah. I don't know. None of my friends seem to be good mechanics. We can sit and debate about pistons, and I don't even know what I'm talking about.
But the premise here is emphatically wrong.
Yeah. So anyway, I hope that helps, Judy. Let's.
And by the way, don't invite me to any one of your parties where this is being discussed. I do not want any part of that.
I don't like being at parties when someone's sitting and talking. Oftentimes, I'm sure that happens. Hey, can I ask you a question? You're thinking, it is my time off right now. I'm going to call me Monday through Friday.
I just spill my drink all over him at that point in time. Just really stop.
And you say, sorry, I've had a little too much tonight.
Bam.
All right, let's talk with Steve. Steve, you're with Allworth Money Matters.
Hi, my question is about the 72T withdrawal out of my 401k.
Okay. Haven't had a call like this in a long time.
Yeah, this is exciting. Tell us about your situation. How old are you?
I am 49 years old.
All right, tell us about your situation.
I've got 2 retirement accounts for my employer. I have a 401k and a profit sharing plan. And between the 2 right now, I'm sitting about $500,000. And I want to know at 55 if you think it's possible to double that and retire.
Well, there's 2 different questions here. One is, do you have enough money to retire? And we can dig into that at either today or at some other point in time. The other is whether you can use 72T. And 72T is?
It's just the Internal Revenue Code that has exceptions to the early withdrawal penalty of 59.5. Typically, we see this when someone says they're under 59.5, they're typically under 55. They want to set up an income stream, and you can set up an income stream as long as it's designed to last you to your dying day and not subject yourself to the early withdrawal penalties. Further, there's a provision that says if you are 55 or older in the calendar year in which you retire or just leave your employer, you can take money from that 401k account without any restrictions, without any early withdrawal penalties.
So the punchline there, Steve, is, look, 72T, if you retire and you're retiring around 55, we would encourage you to leave this employer in the year in which you turn 55 and not set up a 72T, but go into the 401k as needed and make the withdrawals from there. And the reason is once you start a 72T distribution, it's much more restrictive and the penalties are much more onerous. So 72T distributions is a series of substantially equal penalties based on your life expectancy and an assumed
Payments equal payments.
payments. What did I say?
Penalties.
Oh, payments assumed on a predetermined rate of return. Once you start those distributions, you can't change them for 5 years or 59 and a half, whichever is longest. But if you just dip into your 401k after age 55 in the year in which you separated service, you can take money out without penalty, just taxes do. So you're asking us a question that will apply to you 6 years in the future. Forget everything I just said. Don't worry about it until you get 6 years in the future.
Okay.
Because tax laws will probably be different.
Most likely change. And if you're really serious about retiring in 6 years, you should actually probably start doing some serious financial planning, which is how do you actually make sure you have enough to retire at age 55, which it means debt.
Well, that would be the next question.
Okay. What's the next question?
I said that would be the next question.
How do I retire?
How do I do it?
Yeah.
Well, like the old adage, they had Steve Martin. How do you become a millionaire?
Oh, you start with $1 million.
Right. That's pretty simple.
Right. So the question is, how much debt do you have?
Just a house payment.
Well, but that payment isn't debt. That's a payment. How much do you owe on the home?
$280,000.
Okay. Are you married?
Yes.
And does your wife work outside of the home?
Yes.
Okay. Is she going to retire at 55?
Actually, she's older, and that is the plan. Yes.
Okay. So you need to actually go and have a financial plan done because at $280,000 on the debt with $500,000.
Does she have 401k as well?
She will have a pension.
How big will her pension be?
Relative to her salary?
It's salary.
No, is she a government employee?
Yes.
And how big will her pension be as a percentage of her final salary?
I believe we're looking about 60%.
Okay. So it's going to be tough with that $280,000 of debt on that house and that house payment. But you could pay someone to do a financial plan, and they'll work you through all the scenarios to show you whether you could do it at 55, 57, 60, 65.
And what it would mean. You retire at 55, here's what your financial assets would be, and this is what it would mean as far as retirement income.
Yeah, and you might say, well, I have $300,000 in equity in the home, and I'm going to move to Bend, Oregon, or, Alabaster, Michigan, or,
Where?
Tupelo, Mississippi. And
That's
then
another hot spot.
And then work through the what if scenarios. But that's not a question we can answer on the radio.
My guess is you probably need to be saving more than you are right now.
That'd be my guess. So appreciate the call.
Yeah, wish you well, Steve. And it's interesting. Those 72T, these were used a lot in the 90s. Companies were retiring people. They were downsizing by offering sweeteners in their pension plan. People were being exited to leave, and the markets were doing good. And so a lot of people were saying, why don't I just take some money from my retirement account? I'm 54, but heck, got this great retirement offer. And so people were setting up 72T distributions. Then the financial crisis, the .com thing hit. It was a bit of a reset on people. Then there's the financial crisis, a bit of a reset on people.
Yeah, you don't see it much at all anymore.
No, but I did reflect. I remember we had some clients years ago. They were 50 years old. I was my wife, 50 years old. They were still working some. They wanted to take that million plus in their retirement accounts. They wanted to take the maximum they could on return from 72T. Well, this is in 2000.
Okay.
And then, Scott, what's the maximum? There's the tax laws changed since then. At that time, you made up your own maximum
You
number.
could set a number. They called it a reasonable.
And they want to know what is the highest reasonable rate of return. I don't know. They ended up picking a number of 9%.
Wow. It didn't stay retired long.
And I remember the time saying, you're going to be spending money in your 50s that you're going to need in your 70s. And of course, we saw the market.
You were right.
Well, it's just,
It goes through cycles.
things go through cycles. And the danger with This is for people under 59 and a half. Most
Yeah.
people don't have enough assets to retire.
Most
under
people should
59 and a
work
half.
till
They just don't have enough assets to retire under 59 and a half. Most people.
yeah. And it sounded, unless you're going to move to you have tons of equity in your home and you're going to move to a really pay cash for a house. And
then you're not taking a 72T distribution.
that's right. And I have been to Tupelo, Mississippi, and not quite certain I'd want to move there, but it's not a bad place.
Why were you in Tupelo, Mississippi?
It was on a bicycle ride.
Through Tupelo.
Yeah.
That sounded like a good bike ride either. But
It was
anyway, I'm
that
just
time
kidding.
of year. It was absolutely beautiful.
Mississippi's not bad.
I liked Mississippi.
Let's talk to Randy. Randy, you're with Allworth's Money Matters.
Hi, thanks for taking my call.
Yeah.
I have a question. I'm planning on retiring early next year, about this time next year. I'll be 57 and a half. And I have a question. If it's better because of the whole COVID stuff, I haven't been able to take vacation. And so I have like 360 hours on the books, which basically comes out to about over $31,000 if I cash out.
Uh-huh.
So I want to know if it's better to kind of milk the vacation before I retire or cash out that whole amount.
Okay,
Is
so
there pros and cons or tax advantage of either way?
well, let's talk a little bit about this. Do you work in a job that pays a defined benefit pension plan, like a pension when you retire?
Yeah. So I'm going to get a pension about $47,000 a year.
Okay. So when is that, and does the pension have automatic increases associated with it?
No.
It doesn't. So it doesn't reset any June or July. So I was in a meeting a couple weeks ago with another advisor and a client, and we had this massive discussion about whether we should use the vacation for another 3 months in order to actually trigger the increase in the pension so that they could actually get a larger pension for the rest of their life. That doesn't apply to you. There's no automatic trigger on the pension.
Well, so every month you work, you may get like $100 more.
I understand, but there's not like a 3% accelerator on the overall pension at any one point in time.
No.
Okay. It doesn't matter then.
Well, if he continues on, if he gets a little slightly more pension every month he's still on the payroll, why wouldn't he?
Well, then because then he's going to lose that pension for that period of time. So it will matter some. And I doubt that every month is driving your pension up by $100. That would be unbelievable.
Yeah, right. Of course not.
So it depends on how they, I guess it could matter if they calculate it, but normally in these things, they actually calculate your pension with the vacation and they don't pay any attention on how this one is paid out.
One thing you could do is funnel a good chunk of this into a 401k.
Yeah. You could funnel probably almost all of it.
The vacation amount. You're saying if I take that whole lump?
Yeah, just move your withholdings on your 401k way up. Or, right? Or, so what happens is it's not going to drive you into a higher tax bracket per se because of the fact that there's going to be a large withholding on it, but your tax liability is determined at the end of the year. So what's your ordinary income?
170.
Okay. And what will your pension amount be?
47,000.
Yeah.
So you're at 100 and so let's do the math, right?
When next year you're retiring?
You said right around now. So
I thought I'll be working only half a year.
Right. So you're gonna be you're not gonna move your tax brackets between year to year because your overall income for the year will be the same. So there might be a larger withholding on that pension on the vacation time as is pulled.
Are you
out.
maximizing your 401k now?
Yeah.
Okay, it's already maximized. Just make sure you maximize it next year.
Yeah, and so what happens is, depending upon how they withhold from yours, they're going to withhold a bunch of money, but the real true tax obligation is actually determined at the end of the year when you file your tax return. So the withholding will be large. You hear this at work. Well, they withheld 45% of my
Doesn't
amount.
pay to work overtime.
Yeah, because they hold this, and it doesn't really have anything to do with that particular tax. Your tax obligation is determined at the end of the year when you file your tax return. And then you either get a refund or you owe more. So you're not moving yourself up into another bracket by taking it as a lump sum. So I would just take it as a lump sum. unless
Okay.
it somehow affected my pension in a dramatic fashion.
All right.
All righty?
Okay, that's good. Okay, because people tell me otherwise, like, oh, well, if you take that lump sum, you're going to get taxed more. It's like,
You won't get
they're
taxed
wrong.
more.
They're wrong. They couldn't be more wrong. Look.
What happens when you get a large check, whether it's a bonus, unused vacation, your employer, the payroll system will go and look and say, oh, Randy's paid twice a month. He's got $30,000 in this paycheck. Wow, that's like he earns $60,000 a month. That's $700,000 a year. At $700,000 a year, we're going to need to withhold at this percentage. That's how it works.
Right? But then when you file your tax at the end of the year, you didn't make $700,000. You just made $700,000 it looked like for that time
And if you don't want to
period.
give the government money, do the calculation beforehand and change your withholdings.
You can change your withholdings to whatever number you want. Your employers are required to inform the employee, the government, I think when the withholdings go over 10, but I've had as many as 25 withholdings on my paycheck before. In the early days, if I had a big lump sum of money coming in and I really needed it, I would change my withholdings to 25, so they'd withhold no taxes. And then payroll people would say, you can't do that. And I said, oh, absolutely I can. You just have to report it to the government. And they're like, well, you don't want that? And I'm like, I don't care.
I'm not going to cheat my taxes.
I'm not cheating on my taxes. I'm just playing the game. And that's why people talk about this withholding, but it doesn't matter to you.
okay, great.
All right.
Okay, thanks.
Thanks,
Ah,
Randy.
who could ever get
And,
so
you know, it's
passionate about
interesting.
a tax withholding?
Well, we're seeing companies move away from the carryover of vacation. And as an example, Allworth, our company, we have unlimited vacation.
For all employees?
Unlimited. One or the other.
No,
So
it's
which one is
exempt.
it?
It's exempt.
Huh?
It's exempt.
We don't know.
It's exempt.
Anyway.
It's exempt. It's exempt.
Which one is it, Pietro? Salaried employees.
It's
have
exempt.
unlimited.
It's exempt employees.
All right.
So for a large portion of the employees, we don't care.
I hear. I mean, I think it's companies do that because they don't have to carry the liability of unused vacation.
which makes sense.
Anyway, well, that's how we're finishing the program. So hopefully you've enjoyed it. Hopefully you've learned something. It's been good being with you. We'll see you next week. This has been Scott Hansen and Pat McLean of Allworth Financial's Money Matters.
This program has been brought to you by Allworth Financial, a registered investment advisory firm. Any ideas presented during this program are not intended to provide specific financial advice. You should consult your own financial advisor, tax consultant, or estate planning attorney to conduct your own due diligence.